Elon Musk is preparing to take SpaceX public, and he's reportedly setting aside up to 30% of the shares specifically for retail investors. This access comes with a steep entry price. The company is currently targeting a debut valuation of $1.75 trillion. To put that figure in perspective, consider Saudi Aramco. In 2019, they raised $29 billion and set the global record with a $1.7 trillion valuation. SpaceX is aiming to eclipse the most profitable oil company on the planet. The demand for this IPO is anchored to Musk's personal brand. Investors who saw the early returns from Tesla are eager to replicate that growth here, betting on the man who built the world's most valuable automaker. This leaves investors with a difficult choice. Is this a purchase of a dominant aerospace infrastructure provider or a massive premium paid for a speculative AI future? The financial math behind that $1.75 trillion tag is aggressive. It places SpaceX at roughly 109 times its EBITDA, the company's underlying earnings. This chart compares that price tag to other giants. GE Aerospace sits at $320 billion, while Tesla and Meta both hover around $1.5 trillion. The top portion of the SpaceX bar represents the hype premium investors are expected to pay. Trading at these multiples leaves zero margin for error. The valuation assumes decades of perfect execution, with no significant setbacks in launch schedules or technological development. To justify a valuation exceeding Meta or Tesla, the company must move past reliable cargo delivery and successfully commercialize an entirely unproven technological roadmap. The first pillar of the business is the launch monopoly. By perfecting reusable rockets, SpaceX reduced orbital launch costs by 95% since 2008, essentially pricing the rest of the industry out of the market. They now maintain an orbital launch cadence of roughly once every 2 days. Using hardware like the Falcon Heavy, they have secured a near-total grip on both commercial and government heavy-lift missions. The next phase is Starship. This $15 billion R&D project is designed to drop payload costs below $100 per kilogram, an achievement that would unlock entirely new markets in space. While this launch moat is deep, it is also capital-intensive and cyclical. Launching rockets alone cannot mathematically sustain a $1.75 trillion valuation. The second pillar is Starlink. This business transforms SpaceX from a launch provider into a high-margin, predictable subscription service. Starlink is the company's primary financial engine. It drove a significant portion of last year's $18.5 billion in revenue through 10 million global subscribers and high-level government contracts. However, this revenue stream is starting to face heavy competition. Amazon is currently launching its own LEO satellite network, and Apple has already integrated satellite connectivity directly into its latest hardware. Starlink remains the company's financial bedrock, but the entrance of deep-pocketed tech giants will likely compress margins over time, challenging the aggressive growth targets set for this IPO. To reach a $2 trillion scale, SpaceX is pivoting towards space-based artificial intelligence. This blueprint matrix shows the strategy. Launch and Starlink are the foundation, but the XAI merger focuses on orbital data centers to bypass energy bottlenecks on Earth. This theoretical roadmap requires tens of billions in unproven engineering, driving the massive valuation premium. Control of this vision remains centralized. A dual-class share structure ensures that even after the IPO, Elon Musk will retain 78% of the voting power. Investing here means paying a premium for an unproven AI concept, while accepting that as a retail shareholder, you will have no influence over the company's direction. At 56 times revenue, an investment in SpaceX functions as a 10-year call option on the commercialization of the solar system. This flowchart illustrates the risks. Those looking for a short-term trade face intense day-one volatility and the likelihood of institutional investors taking profits immediately, creating high capital loss risk. The other path is the 10-year thematic hold. This requires buying the shares with the intent to secure a foundational stake in a global infrastructure monopoly. Success on this path requires the stomach to endure extreme volatility, much of which will be tied to Musk's public persona and headlines. Direct participation in the IPO is a strategy solely for patient, high-risk investors prepared to lock their capital away for at least a decade. For those who want exposure to SpaceX without the direct pricing risk of the IPO, there are proxy alternatives. This ledger shows the difference. Investment trusts like Scottish Mortgage already hold SpaceX at much lower private market valuations. Buying into these trusts allows you to gain SpaceX exposure at a lower effective entry point. The downside of the proxy strategy is dilution. Because the trust holds many other companies, the impact of SpaceX's performance on your total portfolio will be significantly diluted. Ultimately, both the proxy route and the direct IPO require trading the safety of traditional financial metrics for exposure to high-stakes engineering execution. Successful investors will be those who value that long-term potential over the stability of the terrestrial market.